it's impossible for these things to be priced in. Like how bullish this is, BlackRock, Fidelity, etc. They have dedicated managers that go out and sell these ETFs. Like after they launch, there's just going to be waves and waves of untapped liquidity in people's retirement accounts that don't even know that they're buying Bitcoin. Like
this really opens up this conversation of where you're going to go find returns. And as soon as people are unloading their capital into Bitcoin, everyone's going to be hunting for the next one.
My take is that insider trading is absolutely 100% impossible to stop. So you're better off following the richest people in the market who have the most access to knowledge. And I think that's exactly what this chart does, is that somebody knows about the BlackRock, that BlackRock's going to file this ETF, say, a week, a month, 2 months in advance, right? So then what would that person do?
Welcome to Alpha Bytes. I'm your host, Cody White, and we've got a show that's hotter, I dare say, than Peter Schiff's temperature during this latest rally. Someone should do a welfare check on that man. We're going to be discussing whatever really matters here in the crypto space, including the latest institution that's jumping into the Bitcoin spot ETF. At this point, I'm beginning to think we're going to see a cage match. I can't wait. I'm going to sell tickets. JJ Janner is going to put down the broom, and he's going to explain what the whale accumulation chart looks for all of us minnows. Ben's got his coffee and crystal ball. He's speculating on when the Fed will be forced to pivot. I have no idea if it's going to be a twist or turn or something in the middle. That's why he's here. Let's hear what he has to say. And certainly, last but not least, we got Cody. He's got 4 projects. He's doing a like it or spike it, including one that I'm very interested in, which is an AMM that promises LPs they can actually LARP, something all 4 of us who are here today are excited to hear about. In the studio, I've got JJ, I've got Ben, Lily, I've got Cody. Gentlemen, welcome. Let's get started with a market update. So JJ, our resident market leader, last week you were talking to us about the end of June being a significant month with the options expiry and looking for a close. We're getting close now. What is the market saying? What are you seeing now?
Hey guys. Yeah, so last week we got that big breakout we were looking for, tap 30K, currently trading at 30,500. So like you just mentioned, we have this big options expiry, end of quarter options. So typically the options contracts, you'll see a lot higher volume in those contracts towards the end of months and quarters. And June has nearly 5 billion in notional value expiring this Friday. So what's interesting about this, we got to squeeze up above 30,000, and that was thought to be resistance due to the amount of outstanding strikes. So this kind of tells you that the market is trading against the way that the options market was positioned heading into this large quarterly expiry. So we see kind of moving up ahead, there's large calls open at 32,000 as well, which will be expiring on Friday. So it's unlikely that we see kind of the momentum move its way up above there prior to the end of this week. There's always a chance that you could kind of get some sort of gamma squeeze effect. But given the amount of news that's come out already, I think a lot of it's been priced in for the most part this week. So we're probably going to expire somewhere in this 20,000 to or 28,000 to 31,000 range come Friday. And then obviously into July and quarter 3, things are looking quite bullish for Bitcoin. We got that breakout above all of the moving averages that I mentioned last week. It's now above its 50, 100, and 200-day moving average again. DXY has still been rejecting below its 50-day moving average, and it's also below its 100 and 200-day. What we would like to see is DXY make a move down to new year-to-date lows. So far, it's been holding. It hasn't broken down to the low end of the 100 range as it did early in May. It's kind of been an uptrend since then, and right now it looks like it's formed a higher low, but again, it is rejecting against the 50-day moving average. So we'll see how that shakes out into the quarterly close and then into the monthly open of July. One thing that I'm keeping an eye on is gold has been breaking down, while DXY has kind of been a little bit resilient in this range. It doesn't have the strongest momentum, and there's always a possibility that perhaps Bitcoin's be correlated against gold, and that's not going to kind of continue on for the remainder of this year. But at the same time, given the historic correlation there between the two, I would be extremely cautious if we see a higher move in Bitcoin at the same time gold breaks down or DXY moves higher. So these are just kind of the things I'll be keeping an eye on into the end of the month and start of July.
All right. A nice little data dump there. Ben, last week you came in, we're thinking a little bit or looking at the Bitcoin dominance. And as you start to hear this narrative or sort of breakdown from JJ, what are your thoughts on where that goes as we start to hit into the rest of the summer?
Yeah, as it kind of broke out above the 50% line, it was clear that this trend is just going to keep on marching higher in terms of Bitcoin just occupying more of the market cap of crypto. As far as where does it end up, I think we're getting closer to the 53, 54% mark. And right now we sit at 51.75% at the time of recording. And I think that is going to become at 53, 54 spot might be where we start to top out. And as we move into summer, I would like to see that take place just because the rest of the market can either come to life or get prepared to come to life, if you will.
Sounds like a good spot for the alts to pick up, like kind of Bitcoin has all these headwinds. Maybe it gets another leg higher and then kind of consolidates in range. And that would be a bullish setup for altcoins in my perspective.
And just to clarify, JJ, when you say range, are you kind of looking at the range we're sitting at now, or are you looking at the broader range, which may be 24 to 32K?
So one thing I've been kind of eyeing since we broke out in January, actually, is there's a large CME gap left over from the Luna crash last year, obviously, and that's around 35,700 or so, I'm looking at here on the chart. So I'd like to see Bitcoin obviously go up there and close that gap, and then if it can kind of consolidate in that, say, 34 to 37,000 range for a bit, I think that would be a nice spot. Maybe even lower, like 32 to 37, anywhere in that kind of what we spoke about last week, what Benjamin said is really solidifying the 32K break, turning that from resistance into support, and obviously an expansion move above there, and then kind of just take a breather. I think that would give alts some room to run there, especially if it's paired with the dollar breaking down below 100, which is really what I'm looking for, is like the ultimate bat signal for alts.
I'll jump in there and add, if you pull up that ETH BTC chart, it's been trending on the weekly chart for, this is the fourth candle now, so almost a month of just constant downward pressure. And it almost looks poised for just a nice capitulation movement lower. And once we see that, I think we now have our moment where BTC dominance is topping out and it's time to start exploring other areas of the market.
It's definitely coming. I think maybe a stab higher and then get people to formally capitulate and rush into BTC and then change the tempo.
Just to be clear for the audience, this isn't a week to week. This is sort of a whole play out that could happen over the summer time frame, even going into Q4.
Yeah, we're the Imaginers meme, Imaginors.
I would like to offer a counter to the alt running theory that's heard that. Because I don't know, seeing how negative the SEC and the broader regulations in the US and out are towards alts in particular, and everyone's kind of waiting still on that, like for the hammer to drop on a possible DOJ not sentence, but the DOJ going against Binance. I feel like alts are and will continue to be something akin to the 2019 run, that if BTC runs, it will run by itself, and altcoins will lag and will not catch up at any point. And eventually, when Bitcoin does correct, altcoins will correct even further. So, and like that, I know shouting BTC down is around, but like if you look at itself for BTC down, it finally broke out of like a consolidation that went on since May 2021, and it has ways to run. So, yeah, I think if you're trying to catch up playing altcoins, you might get burned.
That's a great point, and I'm glad you chimed in on that, Cody, because just because BTC dominance starts to top out does not mean, as you mentioned, alluded to, it's time to go far out on the risk curve. If anything, I think it just speaks to a step down the risk curve. And so that next step in crypto would just be ETH. And that time period can last quite a long period of time. I mean, 6 months type of time frames. And as we take another step or just a little shuffle, if you will, to other L1s and keep kind of going down that risk curve to eventually get to the alts, like when we finally get down to that tail end, at that point in time, we're looking at, I think last time this took place was, I'm trying to remember when Elon Musk was on Saturday Night Live touting Doge. I believe that was in May, I think it was May 2021 is when he was jumping on screen, and that was sort of the end.
Yep. That, like, the thing about alts too is you have to be so picky with them. Like, when I say alts, I'm more or less talking about Ethereum, and then that's kind of my version of alts, is I would go with Ethereum, and then maybe things start to really ramp up, like DXY is a proper breakdown to like the low 90s, then maybe move out further. But I just think that might be a spot, like if Bitcoin goes to say that 32 to 36K range and just chills for a bit, consolidates, the bullishness increases, that's when I would start looking at kind of a move up from Ethereum specifically, and just a drop in the ETH BTC chart, less so than a drop in BTC dominance, because a lot of the BTC dominance obviously is weighed against things that could either be completely regulated away by the SEC or just non-value add projects in the current environment.
I want to push a question out here to you three. we've looked at the work that's being done by the SEC to really clamp down on the market. And Cody, you just gave a nice summary of the impact that could have, at least within the United States. But at the same time, we're seeing headlines coming out from China, from work that's being done in Hong Kong. I think just today, I saw a headline coming out from Japan talking about how perhaps they can be the next place, a mega capital for crypto. Is it possible that the demand for altcoins could be offset from U.S. institutions and retail with those other jurisdictions?
I believe so. Like, I think there's kind of creates a vacuum, right? So if one place says you can't do it, then there's always you can't shut down that market entirely. Will the liquidity be the same? Like, that's kind of the issues that you run into, but there will definitely be winners and losers as this thing shakes out. And I think there will be some alts that kind of rise from the ashes. And the SEC actions, I think it might actually be bullish for some projects that are quality. And even if they are securities, like, that's not necessarily the worst thing in the world. Maybe in a short term it is, but if they go in and register as securities, and then all this risk that's been weighing on the altcoin market for 2 to 3 years now, where everybody's like, hey, these things are securities, they're not registered. If all of a sudden that's cleared up and we have clear guidelines, I could see that being a very ironically bullish catalyst for alts. Once we know the rules of the game, right? Then all of a sudden the overhead risk is eliminated and people can allocate capital without that fear.
It's a nice catalyst for essentially the legacy L1s that I think have a little bit of a really established user base and the ability to lock up capital on their platform. And the reason for that is they've been around for a long enough period of time where so there's a draft bill going on through Congress right now that is currently awaiting Janet Yellen and Gary Shades Gensler to provide comments and analysis on. And the reason they're asking, I believe, what's her name, Waters was asking them for the comments because this bill has some legs. It's got some momentum. And because of that, understanding what that opinion is, it's going to boil down to this decentralization clause. And when a token initially gets distributed out, the distribution isn't essentially, I don't want to say fair because that's not the best word to describe it, but it hasn't really moved out to the broader reaches of the ecosystem. And that alludes to not being as decentralized as maybe regulators would want it to be. So the projects that have been around for a longer period of time are more likely to be bucketed in this decentralization definition that they end up coming to. And I think that would be a very bullish case for essentially the alt L1s that have been around for a while.
Yeah, agree. Just clarity is bullish because right now we just don't know. Like, everything, I think right now what you see in the alt markets is the worst case, like nuclear options are almost priced in at this point for a lot of these coins. So as kind of the quality projects get clear rails there, it'll definitely be a bullish.
There's a certain underlying theme to what you just said, Ben, which is sophistication and how participants are going to have to approach the market going forward. I feel as though there could come a time, and I don't know what the timeline looks like, where the memification of an asset in this space could not have the same power. However, that's offset by the power of these actual protocols accumulating their TVL, going up and accumulating users and capabilities. That's actually a good thing for the maturity of the market, but it may not look like what we've seen in previous cycles.
You know, I wouldn't fade the meme economy. It's powerful. And Cody did a nice piece, I forget when it came out, but he looked at essentially dog themed tokens. And he looked at the distribution of those tokens throughout the ecosystem. And the better that the distribution was, the lasting power, there tended to be a longer lasting power for that token. So if we think about memes in general, the images themselves and what they kind of represent, like, how does a meme token get to the point where it has some sort of usability or utility in this online world that we live in? You know, I don't have an answer for that. But if something comes around that has great distribution, that encapsulates some sort of meme and can really have a hint of utility to online communication, I would be all in on that thing. Not all in, I should say, but all in if I ever had a meme.
You're right. Financial advice, go buy up some dog coins. It came directly from Ben Lilly. I'll send you his address. It's going to be in the comments section. No, as always, just a reminder, none of this is financial advice. These are just a couple of friendlies giving you some perspective and opinions here. All right. So interesting take, I think, on the market, and actually a good discussion on what to consider if you're looking at investments. So we've got the power of Bitcoin, its dominance likely to continue to rise. They may not look great for altcoins for a period of time. And so if you've got dry powder and you're really interested in those altcoins, consider what was just shared here. I think there was a lot of alpha there. But let's take this as an opportunity to move on. JJ, you posted a chart on Twitter, which is looking at the whale accumulation. And I imagine some folks are thinking to themselves, we all knew the whales were accumulating while all the minnows were putting their coins back into the water. But walk us through what this chart says and how you're looking at the data.
Yeah, so this has been something I've been eyeing since the April top. When Bitcoin first crossed 30,000 in April, we saw whales buying literally at the peak of that rally. So when Bitcoin first went over 30,500 or so, that's when we saw the red dots on this chart here. And what the red dots show is when any wallet that's holding, I believe it's greater than 10,000 BTC, when they're net adding on average, if you took every wallet that holds greater than 10,000 BTC, and at the end of the day, if they have a higher balance than they did at the start of the day, that registers a red dot on this chart here. So you see they're very sporadic at the times that the whales will enter. And obviously, typically they tend to enter at bottoms of the markets or prior to major up moves. So then buying at the peak of the April rally and then continuing to do so throughout all the rest of April and all of May, early June, when there was all of these obviously bearish headlines coming out and it seemed like, the top was in for the year and people were freaking out, these whale wallets continue to add. So that was kind of something worth keeping an eye on. I mentioned it a few times on Twitter. And now we see even despite the ETF news, they're continuing to buy up. So what that would signal to me is that obviously most likely expansion will happen, and we haven't reached the top of this rally yet. In quarter three, we'll probably go higher. Given the amount of time that they've been accumulating, it's the longest since October of 2020 through February of 2021. So during that period, it was obviously like a 4 or 5 month span, and they were just basically buying every single day. You can see on the chart there. Those wallet addresses were net accumulating for that entire span. Then they basically took all of 2021 off with the exception, of 2022 off with the exception of the bottom there. Right after FTX, we started to see them kind of enter in again. And now we're really seeing them ramp up the accumulation. So that just says to me that there's bullishness, and we may not know what the catalyst will be, just as we didn't know that the BlackRock catalyst was coming until it happened. These wallet addresses tend to be smarter. That's why they have more money and more in the know than us.
I want to see this chart going back to 2011. I love this chart and that it gives me this really clear indication of when the whales, these wallets, are kind of buying up. I'd be really interested to know what this pattern tells me going back through previous cycles. Do you think that there's anything that is the typical history doesn't repeat, but it rhymes? Would we be able to forecast?
If you went back that far, it would be a bit more difficult because the price of Bitcoin was so low. So those people are dealing with a lower cost basis. You don't have as sophisticated of entrance. But when you saw Bitcoin above 10,000, I think there's a lot of signal just in looking at it from that point in 2020, when we really start to see kind of institutional presence. You saw MicroStrategy, Tesla, et cetera, entering in 2020. So that tells you that the people who have been buying since then are kind of more in the know of macro events and things like that. They're just not people who got, say, Bitcoins in the Silk Road era and hold on to them. Some of them I'm sure are, but they've lasted, obviously a decade plus at this point. They have some kind of sophisticated intelligence to mark their buying and selling.
Now, JJ, this chart doesn't give us any indication of specific accounts, correct? We can't say, oh, well, we're now able to tag BlackRock. We know when they're buying.
No, they would use a custodian anyway. Benjamin mentioned that to us, is that if BlackRock's buying, they're not going to set up, highly unlikely that they would set up their own wallet. They're just going to pay Coinbase to figure all those details out for them.
So the story here is that the whales are really in here, and they're usually here early. So how do you contrast that with sort of the cycle that you just talked about, expecting some kind of breakdown? I would imagine that the whales are usually in months, if not, a year ahead of the rest of the market.
What do you mean in terms of expecting a breakdown?
Well, we have the current rally that we've talked about going all the way back to the beginning of the year. And we were just talking earlier about expecting this to kind of top out, maybe the Bitcoin dominance and maybe the Bitcoin's current rally going into summer and Q3, Q4 of this year. But, if these whales are actually accumulating, my sense is that they're actually accumulating in advance of the halvening, not necessarily what's happening with today's price action. Is that your take on it as well?
My take is that insider trading is absolutely 100% impossible to stop. So you're better off following the richest people in the market who have the most access to knowledge. And I think that's exactly what this chart does is that somebody knows about the BlackRock, that BlackRock's going to file this ETF, say, a week, a month, 2 months in advance, right? So then what would that person do? Obviously, they would accumulate Bitcoin in because they have knowledge that nobody else has, and they would use that to profit. So I think that's what we're seeing now is like maybe we're underestimating how far this rally can go. There's nothing to say it can't go into the 40Ks this summer, and then we see them take profit there and possibly reaccumulate before the halving. So I just kind of leave my mind open, flexible to the possible outcomes that I don't have the knowledge that they have. So when they start selling, then I'll kind of be more entertaining of the top being in on this rally. But if they're accumulating at this range, it's very hard for me to say I'm going to take the other side of that bet, right? Like if they're buying, somebody else is selling, and I wouldn't be in a rush to be the person that's selling to these whale wallets.
I think you just accused Gary Shades Gensler of not policing the traditional markets. You just mentioned there may be insider trading. Did I hear that correctly?
Scandalous, isn't it?
No.
Shocking revelation.
You heard it here, folks, right here.
If you go, jump in real quick, just 2021, how many times do we see some of those talking figures say that they're out or they're selling? Even Jerome Powell, I believe, was on that list.
Yeah, the Fed literally had two presidents that were insider trading throughout the 2021 rally.
And now we hear both of them changing their tune about crypto and Bitcoin.
So yeah.
You can't make this stuff up. You really can't. Oh boy. All right. Well, listen, you can, as you said, you can follow the whales. They seem to have the information that everyone needs to lead the market. Anything else here, JJ, you want to share before we move on?
Nope.
All right. Ben, we're going to transition to you. You've got a chart that's literally making my brain bleed with the amount of squiggly lines you have here. Just walk me through what you're seeing here, because it's a little bit of a mess, but I think you're going to distill it into something digestible for our audience.
I would hope so. I probably should take a swig of this Panther espresso. I think it's a 1980 something. I don't remember. I got it when I was in Miami.
Has that been aged? It sounds like the beans were aged somewhere in a cavern somewhere in Colombia.
I would like to think that makes it.
It's hard.
Nice.
It's not
good marketing. Yeah.
Yeah. So what I was looking at today was the 30-year yield chart in particular. And the reason I blasted all those lines on that chart for you, Marconi, was just to show essentially how wide the gap is between essentially short-dated treasuries and long-dated treasuries. It really hasn't been this wide, and I really don't know the last time it was like this. So that's the inversion that everyone's alluding to. And so right now, you look at the 1-year treasury, and it's at 5.3% is its yield. In the 30-year, is it 3.8%? That's a pretty big and substantial difference. And you're sitting there with dollars in your pocket and you want to go ahead and get a return on those dollars, and you're looking at treasuries and you want essentially the most pristine form of debt you can find, you're looking at treasuries and you're probably leaning towards the 1-year versus the 30-year just because of the return. And this kind of alludes to a lot of things that are happening in the economy. And when we think about what's logical and what's not, that sort of time preference and the yield that is being given is not logical. And so what I think it speaks to is a lot of the uncertainty in the economy right now, where maybe yields or the Fed is just going to drop rates to 0% again and do some more ZIRP for many more years, or they might go ahead and just jack it up 10%. And so you want to sit in those short-term treasuries, because now you can kind of rotate your capital back into treasuries once they get essentially unlocked, to use a crypto native term, and then go ahead and get that higher yield because rates are going to keep rising.
Seems like the market kind of has the Fed in checkmate with that, right? Like it's like, okay, if you want to keep jacking up the rate, we're just going to stay in these short-term treasuries, and they're not taking them at their word that they can kind of keep rates this high or at any meaningful level for very long without an implosion.
Yeah, that's a good point. And a lot of people point also at that repo market that's got like almost $2 trillion, I believe, still sitting in it. And with the Treasury wanting to go ahead and open up its account at the Fed and load it up with more dollars by issuing more debt, a lot of folks are worried that the liquidity crunch might take place. And this is kind of appeasing the thought that rates are going to go back down to 0% because the liquidity might be drying up when treasuries start getting issued. But to figure out like how much truth there was into that, I went ahead and pulled up some of the more recent 30-year auctions. And just to quote the CME group, and let's see, which one is this? This is the June auction. They said the results are strong for the monthly 30-year bond auction, where coverage at 2.52. So that's the amount of bids relative to the amount of treasuries that got doled out. So anything above 2 is really good. So this was 2.52, was the highest since January 2020, suggesting robust interest in the 30-year treasury. And what that tells me is because it's so low in terms of the yield, that they need to issue more debt out there. And if they were to go ahead and do that, then the curve will start to normalize itself. And problem is, that means you're issuing less debt on the short term. And if you start doing that, then the yields are going to start dropping below what the federal funds rate becomes. And so this gets into like the plumbing of the financial economy, and you don't want rates driving below the federal funds rate because you run into other issues in terms of cost of capital. What I think we're going to see here coming up because of all these dynamics is we will see a 25 basis point cut near the end of the year. And part of that is to help allow the Treasury to roll out long-dated debt. And if we start to see it, what I think is going to accompany it is probably a large infrastructure bill that would come through Congress, just because you got to somehow get all that debt out there. It'll be bought up on the long end. And I know a lot of people give the Fed a lot of hate here, but if they can pull that off, that's pretty impressive, especially after considering how much money they just dropped into the economy during the pandemic. And to be able to raise rates at the speed at which they did, we should kind of tilt our hat to them to some capacity. That can't be easy. I mean, it's shock after shock, and we still see the market kind of humming along. Maybe not at the highest clip, but it's still going.
I still worry that there could be the effects of that. And I'm kind of eyeing like the August to October, just based on technicals and whatnot, for some kind of liquidity crash to happen at that point due to the cumulative effects of those things. But if they're able to get out of it and we avert those disasters, then absolutely you're right. Then very impressive job for them to raise that harshly that quickly and avoid any kind of major systemic shocks, aside from obviously March of this year. You take out that.
If they do pull it off, like think about how right and how wrong a lot of the market will be. Because a lot of people are expecting this crash to happen. And if somehow the Fed does just navigate the economy and their monetary policy through this craziness and pull it off, we're basically queuing up to a melt up. And a lot of people are going to be very wrong. But on the flip side, people also have that consideration that QE is coming and we should be bullish and we should go ahead and start to position ourselves accordingly. But if that's not the case and kind of the doomers end up being right, like that's now a lot of people caught off sides. And it's amazing just how much, like how bipolar the market is becoming.
I want to point out one of the justifications that we've seen, actually the primary justification we've seen over the last, every single hiking cycle is inflation. And you didn't mention inflation. So the numbers came in and they were tepid, but there's the argument that we're going to see those numbers continue to pick up because the inflation is structural. The other argument is that it's actually disinflationary, that we're going to see prices actually dropping based on perhaps inputs in China and sort of a lackluster economy there. And so the opening back up hasn't been as strong, and that we're going to see some of those costs coming down. So how does that factor in to this analysis that you just walked us through?
That's a great question. I mean, a lot of this kind of structural inflation that kind of exists has to just do with labor rates throughout the world. And this is a byproduct of globalization. A lot of products being purchased from and being imported from abroad. And the high demand for these goods allowed for these other economies to start being able to charge higher prices and give higher labor rates and food, which TD, as he travels, I love hearing kind of his boots on the ground type of commentary of how much food has hiked from places that he has visited over time and the changes and even the cost of rent. It's really interesting to hear. And you pull up the stats and you can see these kind of GDP per caps are really just the cost of labor in these countries rising so much. And so when you listen to those talking heads at Bank of International Settlements, the IMF, and World Economic Forum, a lot of things that they talk about is kind of deglobalization taking place. And this has to do with what we're alluding to here, and because they want to somehow curtail inflation a little bit. And this is how they see the long run of having to bring it back down. And will we see that? overnight. No, we really won't. But you are starting to see a reinterest in renewed, I guess, kind of manufacturing interest domestically, especially like for kind of they cloak it in kind of patriotic type of terms and security and got to keep everybody safe and yeah, we'll see probably that narrative start to continue and kind of change that inflation discussion.
Also, like all roads lead to more cutting, right? So like if inflation's come down a good amount, or we kind of had that crash moment, that's going to lead to cuts. Or if, like you said, if things just kind of iron themselves out and things don't need to, if we could have that melt up scenario where it's like the Goldilocks, everything works out perfectly, the fears are alleviated, then they can cut just because things are moving smoothly. So I think there's easier monetary policy on the way after what we've been through in the past year.
And I think a lot of this rhetoric too is just like, how do you get more productivity? Because if you can have better productivity, that cures a lot of these inflationary issues that are being discussed. And I think that's why AI is so appealing to a lot of people, because it allows a lot of automation and it will help a lot of these stats to kind of bury inflation for decades.
I'm already fearing my AI created timeline for Twitter, which is just AI bots talking to me about other AI bots, a completely synthetic world. Yeah, this is an interesting perspective if the Fed is actually able to thread the needle. I haven't seen too many people talk about a soft landing. I think just this week I saw a few commentators in this space, TradFi specifically, not necessarily specific to crypto, talking about a soft landing. So I guess we'll continue to see if they're able to thread that needle. I myself remain skeptical. I feel as though the DeFi or the deflationary narrative feels a little premature when I look at energy prices and when I think about the time it's going to take for that AI to really kick in with productivity. But time will tell.
I agree, but I want to add just one more point to bring it back to crypto, because I think this is primarily a crypto podcast, so we should always kind of bring that into perspective. Which is this productivity angle, right? Like the 30-year, which is again why I'm looking at this 30-year yield. If the yield starts to creep higher, that tends to allude to better productivity in the long run. At least that's what people say. Whether that's true or not, we'll find out. But if crypto can enter this conversation, and maybe smart contract, because that's the language everyone's kind of hinging onto, is tokenization and smart contracts when they think of blockchain and digital assets. If we can see this automation angle start coming into crypto with smart contracts, I would take that as a very bullish sign here that, yes, if a bill's coming through, more debt's getting issued, things can normalize, and there can be this discussion on productivity, and you see smart contract language included in whatever talks are happening, like that's a really good indication that crypto is part of these plans.
That'll just be a factor of the policymakers getting younger overall too, right? Like, I think people probably born after 1980 or so have like a really good understanding of these things. So as they kind of get into positions of power, we'll see that transition happen and more of this technology be adopted for government use and kind of more official use than just internet speculation. Meme economy.
Yep. Meme economy. It's all going to be dogs sitting in smart contracts, maybe a few cats and giraffes. I for one, am looking forward to our future financial overlords who are covered in memes in some way, shape, or form. But yeah, it's definitely something to monitor here. Ben, we're going to have to revisit this in a couple of months and see how this is progressing, because it's, again, if they're able to thread the needle, I think it's gonna make for a very interesting market play. Let's take this time to get Cody, who's been sitting quietly in the corner, waiting to unleash his perspective. Cody, you ready to go through 4 of these different like it or spike it opportunities?
Yeah, sounds
Okay, there's the enthusiasm. I'd love to hear. All right, first one. We've got ARB tokens. 80% of the airdropped ARB tokens are still sitting idle in DAO multi-sigs. Like it or spike it?
like it. I think they're doing what they're supposed to do, which is opportunities to use those tokens. Like most DAOs, if they're smart, they will use those tokens as incentives to drive either TVL or volume to the protocol. So whatever they want to use it for, whatever metrics they need to be successful, you should be using those ARB tokens to drive incentives. And my feeling is they're just waiting for the bull market to come back, for retail to come back, because if they spend them now, they won't be able to spend them later. And when used well, when used at the time when there's tension and markets going up and everyone's feeling nice and fat and happy, they can drive a lot of success to multiple protocols. Like Optimism had similar incentives and they dropped them just after the June-July bottom for Ethereum, which coincided with the merge and everything. So there was a lot of excitement, and TVL and Optimism went from like 250 mil to 250 million yesterday to 1.15 billion. So yeah, that just goes to show how well those token incentives. So yeah.
So you like it? So the DAO are doing what they're supposed to do.
Mm-hmm.
All right.
That's my read on it. I don't have an insight. Maybe they just forgot about them.
Forgot about all the ARB tokens they received. Well, let's see if their memory gets refreshed in the next bull run. All right, let's move on to the next one. We got ZK Sync ERA. It's the number one roll-up by aggregated fees paid on L1. Like it or spike it?
I like it. So their success has been quite incredible. Like they are sitting at 180 million in TVL. They're just before Cardano and Phantom, which are like established chains. And they are like Polygon ZK EVM, which is like most similar chain that came out recently, which is another EVM based on ZK technology, is sitting at only 30 million in TVL. The DEX volumes in ZK Sync have just happened to the right. They are doing over 50 million daily, which is, I think yesterday was the highest DEX volume day at 30 million. And yeah, they keep seeing inflows as well. They're dying down a bit, but still like there's like 130 million in stables sitting in the chain. It's quite healthy, I'd say. The downside to it is that a lot of this activity is probably just people trying to gain a potential airdrop. Everyone knows that ZK Sync has received a lot of funding. They did not drop the token, like they not pissed about it, but like they have basically acknowledged that they're going to release a token and decentralized governance, yada yada. Whether they're doing it for that or like because they want to get the bag, which anyone's yes. But yeah, as ZK Sync token is probably coming, people trying to get some points, get some tokens maybe. And yeah. So that's the answer to it. The other thing you could say is a lot of those people that are using the chain, other than bots, yes, but a lot of them are actual users. And if the chain can drop some, if some protocols that are interesting can be developed in the chain, those users can be sticky, even more so when they receive a token. Like with chains that are interesting, like Arbitrum, the moment the token is dropped, you don't see everyone leaving en masse. A lot of people actually stick around, and if they can also use those tokens as rewards for teams that are building on ZK Sync, that's also going to be good for the chain. So yeah, I like it with a bit of caveat, but I like it.
Yeah, it sounds like it's a bit premature to really have an opinion, but right now we like it, and it's good to see some development there. Let's move on to the next one. We've got Maverick Protocol, 3-month DEX, making it to the top 10 by volume. Like it or spike it?
I like it. It's yet another AMM, but it's a bit interesting. They have this, they call them modes. So it's an easier way for liquidity providers to drop liquidity. As you can say, it allows you to be a LARPer or just lazy. And you can decide how to let's say drop your liquidity. So it's similar to Uniswap V3. The moment you decide to provide liquidity, you have to choose an upper band and a lower band. So you're providing liquidity within a bin. What Maverick allows you to do is to tell that bin to move to the right, to the left, or to both sides, or to remain static if you think it's a stable pair. But those moves to the right or to the left, they are native to the smart contract, so no gas is spent, and you as a user don't need to do anything. Like the moment price moves, your liquidity bin will follow at no cost to you. So that's just great for LPs. And people like the AMM, the TVL has been increasing. I think it's sitting now at like almost 50 mil. Yeah, 45 mil, plus 60% month over month. And the top 10 by volume on the weekly, and top 7 just behind the other two on the daily volume at 65 million. One quite interesting thing is that if you look at the volume divided by TVL, is very efficient. Like it's sitting at a rate of 1.55. So that means that for every dollar in TVL, there's 1.55 in volume. And that's much better than Uniswap or Curve. Uniswap points are sitting at 0.22, Curve is sitting at 0.03. So yeah, it's quite an efficient AMM and looks good.
So right now we got three like it's, and up like it's Cody, you better not be holding back on me. I want you to really unleash the fury. We got one last one. As I said, don't hold back. We got Raft Stablecoin R, which is only backed by Lido staked ETH, achieves 30 million in market cap in a month. Like it or spike it?
Again, I like it. They're basically doing everything different. Basically, you give them your staked ETH in this case, and they give you the stablecoin. It works the same way as DAI. You give them some kind of collateral, and with a high enough collateral ratio, and they give you stablecoin. And the change for Raft is like, they're like, we don't want all the headaches that come from governance. We don't want to get too bloated. We're just going to release this as you give Lido staked ETH, which is the leading LSD solution, and you can get the stablecoin. There's no other collateral. There's no plans to add any other collateral. There's no plans to get governance, or I think even to release a token maybe. I'm not sure about that, but I haven't seen anything on that release a token, so it might be a possibility. Like, it might be a bit detrimental because people like to have different sources of collateral, right? In order to mint stablecoin, it's what allowed DAI to grow as much. But I think they have something that might allow them to capture quite a bit of TVL and grow their stablecoin market cap, which is that they allow you to go leverage on staked ETH APR and pay no interest. So you can give your staked ETH and go up to 6 leverage on that. So if let's say the APR for staking your ETH is 3%, you could get up to 18%, and you pay no interest to the protocol. You pay a minimal fee at the start, but you don't have to pay any interest. And something like that, Aave and Maker are the similar protocols, and they only allow like 3 and 2x, and you need to pay around 3.5, 3.75% in interest cost yearly. So that obviously it's away at your possible winnings. So I think that is what might allow them to grow, especially considering how the APR for staked ETH is going down as more and more people stake their ETH, and just will continue to go down and down until it's quite negligible, almost. Like, it wouldn't surprise me if it goes down to like 2% in the next few months, which really isn't that much. So I think more and more protocols will try to come up with weird ways to incentivize or boost that up if they can.
I think you just said weird ways. Some might say degen risky ways to come up with the additional.
And it's quite simple. The other, like, one of the reasons I like this protocol is just, it's so simple. It's difficult for something to go badly. And now I know that a week from now, Raft will go down in flames just because I said this, but hopefully it doesn't. But yeah, I think one of the only, like, or maybe not the only, but like the easiest way for you to boost your yield is, yes, to degen a bit, but people like to degen a bit, so that's why a lot of people are here. So just give the people what they want.
Right. Well, amazing. This week we got 4 for 4 like it's. I don't think that's ever happened. I'm ecstatic. And I know you didn't hold back because you got enough data to run a small.
I thought you were supposed to be bearish alt.
Yeah, that's right.
No, I'm an optimist at heart. I'm very results right now and for the next, I don't know, months, but I'm very bullish.
I love it. All right. Well, let's pivot now to a discussion. It's something we talked about last week, that the BlackRock ETF that was launched. But since then, and I think even during maybe that last discussion, we've had multiple players that are launching. We've got BlackRock, obviously, but we got Fidelity. We've got Morgan Stanley, Goldman Sachs, BNY Mellon, Invesco, Bank of America, all TradFi firms that are doing something in the cryptocurrency space. We've got spot ETFs that are opening up. We see some of them that are looking to be custodians, others that are doing future trading. And I've got a chart here that has the total assets for these firms sitting around 27 trillion, all looking to touch the crypto space. So I guess I want to revisit the question we talked a little bit about last week. We got the sharks that are coming in. That's what I would consider all of these firms. But at the same time, we've had people in the crypto space saying, the institutions are on their way. I think it's hard to argue that that's just not true. I guess I want to hear the perspective. Ben, when you see these numbers of these and all of them coming out of the woodwork at the same time, what is your response?
Is to punch that pedal on the right-hand side, which is the gas pedal, and just go.
Rev up, baby.
Yeah. I'm actually looking right now at a meme of Armstrong holding a bunch of, looks like limes, and it says, who's going to hold all these American spot Bitcoin ETFs? And I think that really is something to take note here, which there's going to be some interplay between the two entities, crypto native entities and what's going on with Wall Street here. And this kind of rush to be able to open up one of these ETFs, because if you are early, that's a big difference. I mean, the GLD gold ETF, for instance, has over 2x what the next ETF has in terms of AUM and the amount of revenue is producing. I forget what that iShares is GLD. I read the numbers recently. It's like 220 million at the moment is just off of passive fees. So being first mover is a big deal. And so everybody wants to get some of this action.
JJ, you last week talked about the idea that Bitcoin could be a Trojan horse. I guess maybe you're getting excited that they're all jumping at the same time, so then the horse can start running roughshod over these guys sooner rather than later.
I think it's just bullish is bullish. And I think we're also used to being exit liquidity at one point or another that we kind of doubt our convictions. But I think it was Avi Feldman on his recent podcast was talking it's impossible for these things to be priced in, like how bullish this is, because BlackRock, Fidelity, etc. They have dedicated managers that go out and sell these ETFs. Like after they launch, there's just going to be waves and waves of untapped liquidity in people's retirement accounts that don't even know that they're buying Bitcoin. Like the ETF salesman goes and starts a meeting with the pension fund manager. And next thing you know, they're unloading $1 billion of Bitcoin onto them. And we can't fathom that because we've been on kind of the wrong side of these moves for so long that there is that wave of liquidity coming once these ETFs are approved and money starts running in. It's not to say that it's going to go to 100,000 tomorrow, but over the next couple of years, like as the effects of all of this institutional money and things that have been the walled garden of finance, right? Like if you have a retirement account, it's very difficult, if not impossible, for you to buy Bitcoin. You can only buy these derivative products like GBTC previously. Now we have the ability for them to buy and affect the price of Bitcoin directly through buying these ETFs, which will buy the Bitcoin. So it's going to be bullish.
I'm very
imagining
go on, Ben.
In an envelope and somebody that is wearing a tie and in the envelope is a meme. It's a Bitcoin meme and they're just delivering it in a professional presentation style.
Yeah,
across the world.
We've actually memed it into existence.
Memed it into existence. It is fascinating to see. I mean, they go from everyone dunking on this space as recently as just a few years ago when you saw people backing FTX at the expense of the rest of the industry and looking at other tokens. Now coming in, everyone looking at a Bitcoin or Ether trading opportunity. The latest this morning that I saw was, although Fidelity has offered certain products for Bitcoin in the past to some clients, now they're actually looking, and I think they've filed, the report is that they're filing their own Bitcoin ETF. So Ben, that goes back to the point you're making about the sooner the better if you're looking to compete in the space, and they're clearly not happy with the products that they have on already offering. They want to go a bit further.
And we should also just consider for a moment when gold had its moment in the sun with its ETF, and it had a bull run that lasted from looks like 2003 or 4 all the way to 2011. And afterwards, we haven't seen that again for the most part. I mean, we're just kind of testing that range right now since looks like for the past 2 years almost, or more than 2 years, sorry. Is this going to happen to Bitcoin? And when that actually does, let's say it does happen where we just kind of trade sideways for many years, what's going to happen to that ecosystem? I mean, there's a lot of pros and cons happening right now. And I think it's causing a lot of people to either be very bullish about price, very excited and kind of welcome it with open arms. And then you have the other camp which like, hey, these are the folks that we were trying to not become and not let them into our domain because Bitcoin TM, we mentioned it last week, mentioned it again, but that worry is legitimate. And what does that do to the utility of Bitcoin? I mean, those conversations are fascinating. And I don't think anybody knows really what's going to happen here, which makes it even more fun to watch.
I think it's fighting the battles as they come up. So like, as long as you could take physical property of your Bitcoin, hold it in cold storage and those things, like as long as that's not being infringed on, which I'm sure that fight will come up down the road, I think this is just a bullish development and you would kind of welcome these people in because they're going to add to the liquidity. And ultimately what that does is it builds up legal resources. So as like, if that were to ever get to be kind of a legal fight where they try to make a private holding of your keys illegal and things like that, then I think you just cross those bridges as you come to it, in my opinion. But there's no doubt in my mind that there's probably some nefarious purposes to this in the long run, but whether or not they'll actually be able to carry it out, like it's much easier to take physical receipt of your Bitcoin than it is to lug gold bars around. So I think, like I said last week, I think if anybody will be on the losing side of this long term, I think it may be the institutions if they think that they could turn it into Bitcoin TM. I think that's easier said than done. We'll see.
Cody, you've been quiet in the background. I want to ask you, institutions coming into this market, like it or spike it?
I like it, but I mean, I think this has been going for a while. Just maybe not like it, yeah. But yeah, it's obviously bullish. I don't think there's much to it, as JJ said. Sometimes what this bullish is bullish. Yeah, people just overthink it.
Yeah,
Don't make curve it.
Don't make curve it. One other point I wanted to bring up is, Ben, when you've looked at the gold world and the ETF and the impact it had over its bull run, it's interesting to ask the same question. What about the knock-on effects to some of the other metals? So in this case, it would be, if we look at the ETFs that are coming out for these, what would be the knock-on effects to other assets that maybe aren't in an ETF, but could they be receiving some of that liquidity over time?
Yeah, it's a great point. I mean, this really opens up this conversation of where you're going to go find returns. And as soon as everybody or the truck got backed up, the people are unloading their capital into Bitcoin, everyone's going to be hunting for the next one. Like, it reminds me of the emerging markets trend that took place many decades ago. But, you know, if you had exposure to some offshore company or basket of companies, you know, you were perceived as somebody kind of taking more risk, but also the opportunity for more upside. And we'll probably see that unfold again. The assets that are not trading on exchanges that are easily accessible is going to be looked upon as having higher upside potential. And we kind of know how that story plays out. You know, yes, the gains show up, but those gains disappear just as quickly. And yeah, I think you'll have a little bit of a mania that unfolds around that as well.
This is an interesting time to be alive. I know we could talk about this much longer, but we are getting to the end of our show. So I want to wrap up with, as we like to do here, with a little bit of banter. And this one kind of pains me, but it's also just so funny. Today we're going to be talking about Nassim Taleb. He was recently on CNBC to discuss the risk of the markets at large, and he was asked about Bitcoin, and his commentary was just fascinating. One of the comments he made was that Bitcoin isn't good for money laundering because you can see all of the transactions. I guess that's a negative to him. One of the other comments was that he preferred the Fed because they had, quote, crystal clear transparency and we could influence their policy. So guys, maybe JJ, I'll kick it off with you. I know you're a fan. What would you like to say to Nassim if you got to meet with him in a coffee shop?
I'd use his own terminology against him. He's become an IYI, which in his books, intellectual yet idiot. And it's a shame because I love him as an author, but his Twitter personality kind of spoiled a lot of that from me. And I think this is just an extension of it. He's a brilliant guy, but it's just, I don't know. There are things that, not to say that all of his points on Bitcoin are wrong. Like there are, he does have valid criticisms, but he just gets so emotionally attached to ideas, and you see it happening where now there's almost nothing that could happen to Bitcoin that would ever change his mind from the opinion he currently has, which is disappointing to see from someone whose writings I respect that much. It's almost like two different people. You have there, and then you have the personality.
Yeah, you almost wonder when someone is going to have enough humility to just say, you know what, I've stopped having an opinion here. Let's move on.
Yeah, I mean, he did net, like he was very long Bitcoin prior to 2020. Like he was a very outspoken proponent of Bitcoin, and I think he actually probably made a good amount of money. I think he sold it just before 50K in 2021. That's really when he went on his tangents. But now you see him just the pendulum swaying the opposite way, and now there's nothing that can bring him back.
Ben, thoughts? What would you like to say to Mr. Taleb?
Well, I believe he was calling kind of Bitcoin a cult that got into the financial system. So I would welcome him and say, would you want some of this Panther blend?
We skip the Kool-Aid and go directly for mainline coffee?
Straight to the veins.
Straight to the veins. That's going to keep me going at night when I'm looking at charts.
Being a cult is like, that's a reason to be bullish, I think. Like,
it is quite weird, yeah. I mean, it feels like even with only what he's saying, you can make the case against him. It feels like even if he's trying to come against Bitcoin, what he's saying is actually in support of. Like, imagine if you could have gone long Christianity in the year 100 after.
Yeah,
exactly. It's like
valuable wealth.
Exactly.
Imagine the Enlightenment period of time, centuries ago. That probably was a cult.
Yeah, everything's cool.
It's like, it's not just as money, except in counters with high inflation. It's like, yeah, that's exactly what you wanted for. You wanted to escape financial repression. Like, that's what it all meant for.
Saw it. But that's a perfect example of how him becoming attached to an opinion, he sees everything through that lens now. And he can't look at it from the alternative angles anymore, which for somebody of his brilliance and his background, you would expect the opposite. So disappointing.
Disappointing. I think that's a great point to end this conversation, Mr. Taleb. Nassim, if you haven't blocked all four of us by the time you hear this, we welcome you to come on the show and please explain to us what we're getting wrong about this emerging asset class and the technology that it's unleashed. You're always welcome. We're gonna have a spot for you. But that's gonna do it for this week's show. JJ, Ben Lilly, Cody, thank you for joining me and having this discussion. Really enjoyed it today. If you're looking for more content and you got some alpha out of today, be sure to subscribe to the Exchanging Good channel here on YouTube. You can also find us on Apple and Spotify. Look for Exchanging Good. That's where you can find the podcast. But if you want more of these ideas regularly, you can't wait a week. I get it. I suggest you follow these guys. They're leaking out alpha on Twitter. They're also putting out their ideas in the Espresso newsletter. And as I mentioned every week, we've got more to come. We've got some exciting ideas about how we can connect with this community, this growing community, and share some of these ideas, including the charts and the data, but also have a better way to connect with all you out there. So I ask you to stay tuned and let us know in the comments what you'd like to hear more of. But until next week, this is Marconi White signing off.